continuing on with the standards of professional conduct, let's go on to Standard 5, investment analysis, recommendations, and actions. The first part of the Standard A, diligence and reasonable basis, says that you have to be thorough, totally independent, and diligent in doing your analysis of investments and in making your recommendations and in taking investment action. And you have to have a reasonable and adequate basis for all your recommendations and actions. How do you comply with this diligence and reasonable basis standard? Well, you make a reasonable effort to cover all relevant issues when you're researching a recommendation and when you're making your recommendation. You can use secondary or third-party research. That's acceptable. But you do have an obligation to do general test of the research to see if it's adequate. Do a review of the assumptions, how rigorous it is, its timeliness, the independence of the analysis. And on any group or decision-making that you've done as a group or group research, that's acceptable. As long as there's reasonable basis for your opinion, you don't necessarily have to agree with that opinion as long as you reach it as a group and as long as there's nothing fraudulent about it. As far as procedures to comply with the diligence and reasonable basis standard, you want to establish a policy that research and recommendations should have a reasonable and adequate basis. And you want to have some type of process in your firm to review and approve research reports and recommendations before they are distributed externally. You want to also establish procedures in your firm to make sure that your recommendations have met a reasonable and adequate basis criteria and have measurable criteria for assessing the quality of your firm's research. Examples, research all relevant factors in a situation and don't take on more work than you can adequately handle. Example that they had was an oil and gas exploration tax loophole is closing and time is of the essence. So the manager recommends several firms undertake IPOs at prices based only on the size of the companies. And the manager says he's going to justify the pricing later when the staff has time. That's not acceptable. Just because you have a time crunch doesn't mean you can shirk your staff responsibilities there. So you have to always make sure that you do your adequate research and have a diligent and reasonable basis for your activities. Don't misrepresent a company's prospects. So if you're making a presentation to brokers, maybe your employee exaggerates production level scenarios instead of giving a range of production scenarios. So if you are giving production scenarios, don't just give the most favorable. Make sure you give a full range. That's an example of exaggerating a company's prospects. If you're publishing stock recommendations through an internet chat room, make sure you have a reasonable and adequate basis. You know, even if it's not a formal recommendation, maybe it's more informal, like you're presenting something in a chat room, that still has to have a reasonable and adequate basis, and it has to be supported by proper research and investigation for all your recommendations. If you're managing a pension fund and you're screening equity managers within a region, be sure that you're updating that information on a timely basis. The clients must always receive updated information in the form of an updated report. You need to do regular updates of your research reports. But if you're preparing research and you have to go through a process in your firm where it has to be reviewed, that's okay. And there might be changes made above you, and that's acceptable. An example would be if you're a junior analyst in a firm and you're asked to do an interest rate forecast on the mortgage industry. And it gets reviewed up through the channels of your firm. You may have a fixed income investment committee that reviews it. They make changes to it. That's all right because you're a junior person and your work is being reviewed and analyzed and adjusted. There's nothing wrong with that. Again, if you work for a smaller firm and you elect to use third-party research, that's okay. But you have an obligation to make a reasonable effort to make sure that the research is solid. You have an obligation under Standard B, Part B of Standard 5, communication with clients and prospective clients, to disclose the basic format or principles behind your investment processes. If you're a value manager, you need to disclose that you are that and how you go about making your investment decisions. You don't have to go into a tremendous amount of detail, but you have to inform the clients your basic format or principles on your investment processes, how you analyze investments and select securities. And if you make any material change in how you make these decisions, you have to inform your clients. In your communication with clients, prospective clients, you have to use reasonable judgment in identifying what particular factors are most important in your investment analysis, recommendations, and actions, and include those factors that you deemed important in your communications with your clients and your prospective clients. An important piece of this standard is distinguishing between fact and opinion when you put your analysis and your recommendation together. It's perfectly appropriate to include your opinion in a research report. Just make sure you identify it as an opinion. So, as far as how you comply with this standard, you want to properly distinguish between facts and opinions. Like I said, you want to include the basic characteristics of a security. You want to inform your clients of any change in your investment process. And as we talked about in an earlier standard, you also want to make sure that any investment that you're recommending is suitable in the whole portfolio context. And this covers all your communications, not just formal research reports, but verbal communications you have with clients, anything you have in an email, internet chat room, all those communications are covered. As far as how you particularly comply with this communication with clients, prospective clients standard, the inclusion or exclusion of information in your report depends on a case-by-case review, but you want to maintain records on your research. And the client must be informed of the basic processes and logic that you use in your investment strategies. So you might have a complex strategy that involves trading, portfolio construction rules, and maybe you didn't explain the basic process and logic to the clients. That's a violation. You have an obligation as a portfolio manager to properly explain to your clients how your strategies work. And in issuing your recommendations, you want to be cautious about distinguishing between fact and opinion. An example would be if you're writing a research report and you're making a statement about the amount of gold reserves the company has, and maybe the estimated gold reserves was based on samples from the company's latest drilling. Well, that's still an estimation, and that's an opinion. That has to be described as an opinion in your report. You can't say as a fact that the company has X amount of reserves. Another example, be sure that your report not only includes the basic characteristics of the investment strategy, but it also includes how it was created. If there's leverage in the structure, how does the investment perform in rising rate environments? How does it perform in falling rate environments? You need to give your clients full information on the investment that they're making. If you're managing a fund to a specific strategy, make sure that you notify not just potential clients, but existing clients if you make a change. So if you are a manager and you specialize in small cap domestic stocks and you raise the maximum permissible market cap ceiling, that must be disclosed. And the disclosure to clients and prospective clients also pertains to a small cap universe, not just to the ceiling. So if you decide that you're going to invest in larger cap securities, that must be disclosed to the clients as well. If you're an equity manager and you're using a valuation model, but maybe you decided to change to a different model that's materially different from an investment process standpoint, that must be disclosed to the client, all the firm's clients. Example would be you replaced multi-factor models with dividend discount models. That would be an example. If your responsibility for the stock selection process shifts from individual security analyst to a committee that includes research director, senior portfolio managers, the client must be notified. So if you are picking securities a certain way and then your firm has changed its process and says before you can finalize a stock you're selecting, it has to go through a committee, and that's a difference, and that has to be disclosed to the clients. Continuing on with this standard 5, investment analysis, recommendations, and actions, C, record retention. And it just says that you have to develop and maintain appropriate records. And if you have anything that backs up and supports your investment analysis, recommendations, and actions, any other investment-related communications with clients, prospective clients, you must have records to support it. And the records would include the rationale for your conclusions and your actions. And CFA Institute recognizes that the records are firm's property, and many firms have the responsibility for retaining records through computer systems and backup systems and things like that. But there may be cases where you called on a firm and you kept personal notes. You want to keep things like that. They don't give a guideline of years. If there's no regulatory requirement, but they do say as a guideline that CFA Institute recommends a retention period of 7 years. But if your firm has a different guideline, that might be the case, and there might be a regulatory requirement that requires a certain number of years. That would take precedence. Generally, like I said, the responsibility to maintain records falls with the firm, but you may wish to retain documents that support your investment-related communications. You want to keep appropriate records to show that the client's portfolio is properly following the investment policy statement. And we've talked earlier about the importance of adjusting the IPS if the client comes in and wants to make a change, because it protects you as a portfolio manager. If the client comes in and is upset about losses in the tech sector, for example, you can just point to the IPS that had already been established with the client and said, we had already established that the percentage in this portfolio would be 35% tech. And that protects you as an investment manager. You want to document all information that goes into a report, including any secondary or third-party research of other analysts. Examples would include your documentation of interviews with all parties, your on-site visits that you had in calling on a company when you're writing a report, any customer surveys, any secondary research you did. Just keep the records on it. And finally, on this particular standard, record retention, if you develop an analytical model, you want to document assumptions and reasoning behind them. If you change firms, you may not take the documentation with you. If you developed a model with an old firm, you change firms, go to the new firm, you can't take that model with you unless you have the old firm's permission.